Hi everyone, welcome to ACCA Financial Reporting. Today we are going to look at different standards. We are going to start with IFRS number 13, the fair value measurement. IFRS number 13, fair value measurement. So the first thing you have to know the definition of fair value. What is fair value? According to IFRS number 13, the fair value is the price that will be received to sell an asset or paid to transfer liability in an ordinary transaction between market participants at a measurement date. That's the fair value of the asset. What are we saying? We are saying this is the price that will be received to sell an asset. You want to sell an asset. What is the value that is fair to that asset? You understand? So now that's the fair value, the amount that you expect to receive if you sell an asset. That is the fair value. Give you an example. Let's say you have your assets. Let's say you have your laptop. Then you say, I'm expecting to get $600 for this laptop. What is the fair value? Guys, looking at the company now, a company might want to value their building. We are the accountants, we don't know how to do that. So we end up hiring people who have experience in that area. So we end up hiring professional, independent valuers who give a value to our building. You understand? So what is the price that will be expected, that you expect to receive? Or what? If you look at the definition, I will say the price that will be received to sell an asset or paid to transfer a liability. Imagine you owe someone money, let's say $800 for argument's sake. So then that person will say, okay, you're having cash flow problems, you can't pay me my money. Okay, what if you give me this laptop? Then that will be it. This laptop will settle the liability. So that means that laptop is now equivalent to 800. So that's the favor. You understand? I think that. So guys, I'll give you an example. I can apply even IFRS number 5. Where we talk about the non-current assets held for sale. There are other assets that can be held for sale. You understand? How do you measure, how do you value the assets that are held for sale? Right. Let me take you back to IAS 16 PPE. On PPE IAS 16, we say we hold assets with the intention to use them. The intention is to use them in the production of goods or services, right? Or for administrative purposes. Right. So under IAS 16 PPE, the assets are held for use and they're expected to last for a long period of time in use, which is more than a year. Right. How do you classify this? They'll be classified, they'll be recorded under what? Non-current assets. But when an asset is classified as held for sale, when we now have the intention to trade it, it will be recorded under the current what? Assets. Right? So this will be recorded under current assets and it will not be depreciated, right? So you now want to sell the asset. So now the asset, under IFRS number 5, we say when an asset is now classified as held for sale, when it meets the conditions, such as like the management is committed to a plan to sell the asset, you expect that the asset will be sold within a year. That's why you're classifying it as a current asset, right? Yes, there's an active program to locate the buyers or other examples, so many examples, right? The price that you're charging is reasonable. So when it meets the conditions to be classified as held for sale, we'll then say it will be recorded as a current asset, and we apply IFRS number 5, where we say it is measured at the what? The lower of carrying amount and what? And the fair value, less cost of disposal. What is the fair value? Yes, in the books, you have recorded a certain amount, but let's say in the books, the asset they said is worth 10,000. We will then ask ourselves a question that, how about the fair value? How much do you expect to receive if you sell that asset? Then they'll say, if we sell this asset, we expect to get 9,000, but their cost of disposal, for argument's sake, let's say 500. So the fair value, less cost of disposal, this will be 8.5. But in the books, they've recorded 10,000, but the fair value is now 8.5. Are you seeing that in the books, you have overstated your financial statements? So therefore, you have to impair your assets. You understand? So there will be an impairment loss, because the value which is correct is the lower. So if this one is the lower, we record the books, we update the financial statements and give a value of 8.5 instead of 10,000 that was in the books, right? So this we record 8.5. So this shows that the asset is decreased in value by the difference, which is known as the impairment loss. The impairment loss will be recorded in the what? Statement of profit or loss. Yes, now to some people who couldn't understand the IFRS number 5, I've explained about that. Right, but guys, we are doing the fair value. We are focusing on giving a value that is fair to our assets. So now you now know the fair value, guys. You now know the definition. All right, there are some techniques that we follow. We do have there is the hierarchy. Like you want to give a price. You want to give a price to your assets and liabilities, right? You want to give your asset a price to the assets. What's the hierarchy? There is what? There is input. There is level 1 input. There is level 1 input. There is level 2 input. There is level 3 input. Right. We do have different levels, but the one that is most reliable is the level 1 input. Why do we say so? Why do we say the level 1 is more reliable and we do have quoted prices that must not be adjusted? Why do we say so? On level 1, what you have to understand is we do have, on level 1, guys, we do have the active markets. Taking you back to the definition, it is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. That's the key thing, market participants. So guys, we have to understand about our markets. You understand? So you ask yourself a question that, we want to give a value, but is the market active or not active? So level 1 input will be saying the market will be active, and there will be identical what? Identical assets and what? Liabilities. Right. So we do have identical assets and the liabilities. Right. Identical assets and liabilities. So now on level 1 input, so we do have identical assets and liabilities. So that's level 1, active markets, identical assets and liabilities, right? Right, so guys, on level 1 input, the market is active. There are assets that are identical. So when you have your assets, in the market there are other assets that are identical, and you want to give a value to your asset. Are you saying that this will be easy? You just look at an asset that is identical to yours. How much is it? Oh, that asset that is identical to my asset, so it's 1,000. So meaning that yours is worth 1,000. So it's easy to value on level 1 input. Level 2 input, now it applies now when you have either, now on level 2, you don't have both. On level 2 is either the market is active, but if the market is active, it means you don't have identical assets. Because if it's active and you have identical assets, that will be level 1. The market can be active, but you don't have what? We don't have identical assets, or just say you have similar assets. Or maybe let's say, what about if you have identical assets? If you have identical assets, just know that the market is not active. Because if you have identical and active, that will be level 1. So if you have identical only here, the market will be what? Inactive market. You follow? So it's either you have this or this. That's level 2. Your market is active, which is correct, which is a good thing. But the problem is you want to give a value to your asset, but you don't have an asset that is identical in the market. So you have similar assets. There's a difference between identical and similar. So there are assets that are similar to yours, but it's not exactly the same. So you end up, comparing, maybe that asset is worth 1,000. Mine, let's look at our own. Yours, it can be worth 900 or it can be worth 1.1. So you end up adjusting the amount, you understand? Or maybe you have assets that are identical, but the problem is the market is not active. So if it's not active now, it's difficult to give what? Prices. Then level 3 inputs, we talk about unobservable inputs. Unobservable inputs. So you can't observe, you understand? You can't observe unobservable inputs. Now on this one, you don't have identical assets. The market is not active. So guys, what do? The market is not active. You don't have identical assets. You understand? So what you do when we have this kind of level, we say you use the best information available. If they ask you in the exam, in the FI exam, which one is the most reliable, it is the level one input. So guys, that's IFRS number 13, fair value measurement.